Well, it's the earnings season, and we have ICICI Lombard management talking to us about a great set of numbers that came out yesterday. We have Mr. Gopal Balachandran, the Chief Financial Officer at ICICI Lombard. Welcome to the show, sir.
Good morning, everyone, and thanks for having me as a part of the show today.
ICICI Lombard reported a net profit of around 432 crore, which was up 22%. While it was a slight miss on the Bloomberg estimates, overall positive numbers. The motor segment reported an over double-digit growth. They doubled their operating profits. Net premium income was up 13%. Solvency ratio came in pretty strong. Combined ratio also seems to be on track at 103.6%, I think, which is inclusive of some catastrophic event losses that we saw this quarter. Sir, thank you so much for joining us today. We have a couple of questions here. Motor has been one of your focus areas for the past year, and we've been talking very closely about it. We're finally seeing a lot of good results there. What has worked, and how are the loss ratios also coming out on this front? Are we in a comfortable position? What is happening, sir?
Yeah, I think that's a great question to start off with. I think let me put this in the context of the environment. So I think if you look at new vehicle sales across categories, whether it is private car, whether it is two-wheeler, or for the matter of fact, commercial vehicles, I think we are seeing a lot of positive momentum getting played out. A lot of it is also to do with in the context of the festive demand as well as rural pickups. So across the three categories, insofar as the market momentum is concerned, that's looking very, very positive. That's why, as a part of our earnings call last evening, we had also kind of put out what has been the new vehicle volume sales that one has seen insofar as the market is concerned. So hence, in that sense, I think the demand momentum seems to be looking very, very positive. Now, let me put it in the context of how the insurance industry has been kind of also responding insofar as motor as a segment is concerned. Directionally, if you see, while the combined ratio still stands elevated, but definitely it is kind of 4 to 6% better than what combined ratios that the market has been operating, let's say, 1 year back. So again, even from a market perspective, I think there seems to be a sign of semblance that is kind of possibly getting played out, and hence, which is where the directional change for improvement in combined ratios is also getting exhibited insofar as the insurance market is concerned. And within that, now when I talk in the context of ICICI Lombard, our approach to writing risk, whether it is for motor or whether it is for any other category of businesses, we have always chosen to drive profitable growth as a theme. And what we effectively try doing as a part of this theme is whenever we see opportunities of growth, we obviously kind of significantly deliver better growth momentum. But at the same time, when we, as I said, maybe for a couple of years, when the market has been at elevated levels of competitive intensity, we have always been a bit guarded / cautious. So it is in that context is where maybe for the last couple of years, we have been growing a shade lower than insofar as the market growth is concerned, particularly in the context of motor. But what we are very happy in the context of ICICI Lombard is if you look at the relative gap between what was existing as industry growth numbers in motor and ICICI Lombard growth number is in motor, that has been significantly coming off over the last, I would say, pretty much on a sequential basis, quarter on quarter. For the half year, for example, the gap between industry numbers and Lombard numbers were about 8%. But for quarter three, that gap is down to less than 4%. And for the month of December, we actually have kind of outgrown the market. So hence, I think we are very, very positive and optimistic in the way how one is seeing the growth momentum play out in motor as a category. And for ICICI Lombard, I think we are rightly positioned to capitalize that opportunity for growth. In the context of loss ratios, I think on motor, I think again, we are quite comfortable at the loss ratio ranges that you are seeing for us on 9 months, which for the segment has been at an aggregate at about 65%. I think the range that we have generally spoken to the market is comfortable in the range of 65 to 67%. So at this point of time, I think whatever we are seeing on the loss ratio trends, from an ICICI Lombard standpoint, I think we are quite comfortable at the range at which we are operating at.
Right, sir. So also on the bit of retail health here, we have finally reported a profit versus the loss that we've been seeing for the past couple of quarters. So what has changed? Are we going to be able to maintain the same momentum that we are seeing on the retail health front? And what are the steps that we are taking to now sort of grow further on the retail health side? Also on the group health, the losses have narrowed down. So what is the company now doing to take on more business, or are we seeing better, because now that COVID is entirely behind us, although now we're again seeing a bit of cases here and there. First of all, do you see that as a threat to retail and corporate health policies, and going forward? And also, how has it been for the quarter?
So there are too many questions into one. Let me try and answer all of them. Let me pick up the last piece one, which is relatively an easier one to call out. I think insofar as the COVID comeback is concerned, at this stage, nothing to call out. We are not necessarily seeing any increases insofar as hospitalization slash need for insurance payments are concerned in the context of what possibly one had anticipated in terms of a COVID wave, but at this point of time, nothing to call out, nothing to kind of worry about insofar as the COVID cases are concerned. Now, let me kind of try to address the points that you had in the context of retail health as well as corporate health. Retail health for us, as we have been talking through, has been an area of investment because that's a segment which we are significantly, in the past, we were underinvested. And that's the reason our market share on retail health stands at about 3% relative to the company market share, which is at almost close to about 8.6, 8.7% levels thereabout. So that's an area where we believe there's an opportunity for us to significantly drive growth. And hence, to that extent, is where we are kind of investing in expanding distribution, whether it is in terms of adding our own headcount of employees to drive retail health distribution, and therefore who in turn will kind of go out to the market and get incremental number of retail health agents. On both the fronts, I think we are very, very happy with the way how the expansion initiatives have played out. And hence, in that sense, we will continue to make investments in driving growth and improve market share on retail health as a category. And that's why even if you look at for that particular segment, for the 9 months, our growth was roughly slightly more than 19%. Industry growth numbers was a shade lower than 19%. So hence, in that sense, we have been able to get some marginal market share change. But honestly, there's a lot more that we can do in the context of driving growth in that particular segment. In terms of offerings, I think we continuously keep to look for how we can improve the product proposition, particularly in the context of retail health. And we have been doing that even in the past. And we will continue to kind of look for different product features that we can introduce in the market, whether it is for different age groups, whether it is for different lifestyle related ways of living, etc., etc. On the health side, from an ICICI Lombard standpoint, you will continue to hear us a lot more as we move along in terms of new products that one will introduce in the market. In terms of the loss ratios range on retail health indemnity, again, we have talked about us comfortable operating in the loss ratio range of anywhere between 65 to 70%. And if you would have looked at the 9-month numbers, the retail health indemnity loss ratios has been at around 66% or thereabout. So again, I think we are quite comfortable at the loss ratio range that we are operating at. But as I said, we will continue to expand on driving distribution and service in order to capture the opportunity on the retail health front. Quickly on the corporate health side, again, I think the growth momentum is looking very, very positive. In the market, there seems to be kind of an improvement in pricing that we are seeing in the segment. And hence, we are able to kind of capture incremental opportunity. And that's why we are definitely growing much, much faster insofar as the market is concerned on the group health side. Again, on the loss ratios front, what we have talked about is being comfortable in the loss ratio range anywhere between 94 to 95%. And if you'd have looked at the 9-month reported numbers for us on corporate health or group health, the loss ratio was at about 95%. So on both the segments, I think both in terms of the growth momentum and the loss experience, for ICICI Lombard, we are quite comfortable with.
So then is it safe to assume that the combined ratio guidance that you'd given for FY25 at 102% will be in sight, or are we expecting some delay or miss there?
So honestly, if you ask us, I think at this point, again, let me just put this in context. What we have talked about to the market is to get to, as you rightly indicated, getting to a combined ratio of 102% by the end of FY25. And if you look at the market combined ratios, is still operating at about 112. Insofar as ICICI Lombard is concerned, at this point of time, we are sticking to the combined ratio trajectory of getting to 102 by the end of next financial year. And if you see directionally the path that we have been taking, even if you look at the current year numbers, it seems to kind of clearly indicate that we are on the right course. And therefore, to that extent, we are on course to stick to that 102% numbers by the end of next financial year. If the market improves the combined ratios from the current levels, in fact, it could be the other way around of possibly us looking at possibly accelerating maybe the expectation of reaching 102% by the end of next financial year. So obviously, we will kind of watch for how the market responds, and maybe in a quarter or two, we will come back and possibly see if there's a need for us to accelerate the 102% combined ratios that we have spoken about for meeting by the end of next financial year.
So I'm going to have my last two questions very quick. One is on the marine insurance front. We have issues at the Red Sea, and there are talks that private insurers are indicating a pullback or are leading to certain price increases for insurances on that route. Is that the case? And we've had a phenomenal quarter on marine insurance as well. So what do you think would be the guidance for quarter four, because these issues are now creeping in? And the last is budget expectations, sir.
Yeah, so I think so. If you look at on the marine side, I mean, we are pretty much kind of still offering coverages at a price that we are kind of comfortable with, and therefore, to that extent, is what we have been doing for not just marine as a category. If you look at across portfolios, the levels of pricing at which we are comfortable with is where we have been kind of underwriting the risks at, and that's the reason when you look at commercial lines as a category, which includes marine insurance as well, it has been generally profitable for ICICI Lombard because of the nature of risk selection criteria that we have been able to put in the market. So hence, to that extent, I think that's also seems continues to. And if you look at the opportunity that that segment presents, as you rightly indicated, logistics is doing fantastic, phenomenally very well. So therefore, on commercial lines, including marine insurance, we will continue to outgrow the market. However, we will obviously be again, as we keep saying, be mindful of what does it translate to in terms of loss experiences. At this point of time, no concerns. It still continues to be a profitable portfolio for it as a category. On the budget expectations, I think I think there is obviously, when you look at it in the context of the retail customers, there is always an expectation that one should increase limits insofar as tax deductions are concerned, depending on the various insurance requirements that you have. So hence, that could be one possible ask that could come through insofar as the budget needs are concerned. And the second, I would say, is if you look at increasingly, we are getting to see a lot more catastrophic events play out. For example, this year we have seen 3 catastrophic events. Every year, every quarter, we had seen 1 event play out. So therefore, the need for home insurances is significantly pretty much there. Today, a lot many individuals do not necessarily kind of cover their homes, or even if someone covers their home, they do not cover their contents, etc., etc. The opportunity is humongous. If there is some form of an incentivization that the budget could outlay in this context, I think that again, that could be a great positive insofar as the budget ask is concerned.
Thank you so much for joining us today, sir, and thank you, viewers.